When you look at the piggy bank chart, what does that say about pending disinflation and deflation in the world?
Well, the China piggy bank chart is largely a result of the fact that people know the RMB has to go down as well as go up. So you had a massive rebalancing of Chinese companies' liabilities. They used to borrow in dollars and buy RMB because it was a one-way bet, and that boosted foreign exchange reserves. Once they realized the RMB had to decline a bit, they reversed that. So you had a big drop in Chinese companies' dollar debts and a corresponding drop in Chinese reserves. It's simply rebalancing of the corporate sector. Bank for International Settlements covered that pretty thoroughly. It doesn't really reflect Chinese economic confidence as much as balance sheet.
The reality, David, and you were way out front in this, is the decline in aggregate trade. I say you and Carl Weinberg were quarters ahead of everybody else. How urgent is the decline in world trade?
Well, this is, as you indicate, this is the elephant in the parlor, because with world trade actually negative year on year, with this, as of the second quarter, we're at the point, we're very close to global recession. That makes China's problems much more difficult than they ought to be. China's trying to obviously move from a polluting, factory-based, old economy to a more high-tech new economy, and that's made much more difficult by the fact that their export sector is in very poor shape. China, however, is doing reasonably well. I keep reading Bloomberg stories which talk about a Chinese financial crisis. I don't see it that way. You have state-owned banks that owe money to the state itself. So it's the state that owes money to itself. It's much more a matter of getting labor out of the old industries and into new jobs, moved, retrained with new documents. That's a 10-year process, and it's proceeding steadily but slowly.
But David, how do you see, so we saw some figures, and actually we've also written, to stick up for my team, we've also written a lot of stories saying that China's stabilizing. But today we have China credit growth slowing to a two-year low on this debt curb concern. Again, how are the Chinese authorities seeing this? Are they suggesting that we're concerned, that they're concerned about swelling financial risks?
As an economist, I would argue China's real rates are too high and they should cut rates. But the Chinese authorities, judging from all the recent pronouncements we've had from the Chinese press, are saying the exact opposite. They want to keep real rates high, and that's because they want to keep the feet to the fire of the old industries. They want to force reforms. They want to force a shift out of employment in the old smokestack industries into newer industries. I think it's mainly a political gesture on the part of the Chinese authorities that they're not giving the old industries any breathing room, any way to delay reforms.
Right. But Dave, this seems like a policy priority, right? Is that fair? If they have growth that stabilizes, and again, it may change very quickly if they fall below 6.5% growth, but if growth is stabilizing, they want to focus on curbing financial risk.
Absolutely. Well, financial risk is really political risk. The issue is how much rope do you give the old industries by continuing to finance them? You know they're not going to pay it back in any case, but that's just a liability of the state to itself. Politically, they have to worry about unemployment on one hand in certain regions. In the aggregate, they don't have an unemployment problem. So as long as growth, as you indicate, stays in the 6% range, they'll keep credit tight. If they fall below it, they're going to lean in the other direction and give some rope.